Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have Rick Rule of Rule Investment Media back on the show. Rick, thank you for coming back on the show.
Steve, always a pleasure. Thank you for the opportunity to have a discussion with your audience. And by the way, congratulations on the growth of your channel. It's been great.
Thank you. Thank you. Yeah, we're over 8,500 now. Next goal is 10,000, and my goal is 25,000 by the end of the year. So we'll see if we hit it or not. But a lot of that is thanks to you, and I appreciate you letting me into the spider web.
Well, a pleasure.
Yes. Okay, let's start out. I am really excited here. We've got the Boca Raton Symposium coming up. I've done the live stream on demands in the past. This will be my first in-person conference. What can we expect at the symposium this year?
Well, let's start by saying that this symposium has stood the test of time. It's been around almost 30 years. So we've delivered for people. How have we delivered? Well, first of all, we have great big picture thinkers. The Jim Rickards of the world, the Daniela DiMartino Booths, the Nomi Prins, the Bill Bonners, the Grant Williams, people who teach you about the world as it really is, not the way that CNBC would prefer you to believe it is. Once we've established an intelligent worldview, we have wonderful analysts and portfolio managers, people who've been in natural resource and precious metals business for decades. Beyond that, importantly, we have a function called the living legends, where we have entrepreneurs who have built multi-billion-dollar natural resource companies from scratch, talking about how that experience has made them better investors and how you can become a better investor too. Importantly, Steve, unlike any other symposium of its type, this one comes with a full 100% money-back guarantee. Whether you attend live, which I would prefer that you do, come to Boca Raton, Florida, or join thousands of others in the live stream broadcast, if you believe for any reason that we haven't given you enough information to make it worth your while relative to the tuition that you paid, email me. I'll give you no questions asked money back guarantee. Importantly, too, we're going to give you between 50 and 60 hours of programming over 4 days, more than you can possibly absorb. So we interview every speaker and every exhibitor before the conference, so that you can prepare yourself to maximize your time at the conference. And in addition to that, we record the entire conference, including the breakout sessions, so that for a year after the conference, you can refresh your memory and learn or relearn the lessons that were taught. For those reasons, the test of time, big picture thinkers, real world analysts, vetted exhibitors. No exhibitor can come to my conference, a public company exhibitor, if they aren't owned in accounts owned and managed by myself. Now, sadly, Steve, as you know, there's no guarantee that because I buy a stock, it goes up. But there is a guarantee that every single exhibitor has been vetted. That's where the money meets the road. Because of all those factors, we are completely confident in offering a money-back guarantee, which no other conference that I'm aware of does.
Yes, and if you get your ticket soon, the price is going to go up here midnight, May 15th. So get your discount and sign up early. And you also have a live stream on demand option. If you're not really sure if you're going to be able to make in person at Boca Raton, you can get the live stream. And if it turns out you can go to Boca Raton, then you don't have to pay twice. We'll simply add that to your to the live one. I'm excited also about the resort. This looks like an incredible resort. It's right on the beach. You've got the cruise. Tell us about that.
Well, I'm delighted that you're coming live. because it's actually a better experience. I understand for most people, attending from the comfort and convenience of their own home is better for them. But the live event has several things going for it. I had an email 3 years ago from somebody saying, following one of the living legends, Robert Friedland, around the exhibit floor, paying attention to what booths he stopped in front of and listening to the questions that he asked was worth the price of admission. Everything else was free. So live is better if you can do it. And Steve, I'm absolutely delighted that you're going to be there live. The resort is something special. Michael Dell, Dell Computer, owns it. He has, as I understand it, $1.5 billion invested in this now. It sits on 240 acres in Boca Raton, Florida. There's a half a mile of Atlantic Ocean waterfront. There's a half a mile of intercoastal canal. There's a golf course. There is a hotel there, the resort that we'll be staying at. If you went in peak time in the winter and didn't go at our conference rate, you'd be paying $1,200 a night for rooms. We will turn them to you for $310. So it's a tremendous, tremendous bargain. Now, the conference isn't primarily about the resort, but if you come to the conference live, by all means, bring your spouse. They will be happy that you did it. And then finally, there is an optional boat cruise where we take 400 of you. By the way, make reservations now. It will sell out for the evening on the Intercoastal Canal. The idea that you can have drinks with and enjoy the company of the Jim Rickards of the world, the Daniela Di Martino Booths of the world, the Steve Bartons of the world, is a tremendous feature. So absolutely positively, if you're going to attend live, reserve a place on the boat cruise, which will absolutely sell out. It has every year for the 20 years that we've offered it.
Yeah, I'm excited about this one. I'm used to fishing boats, so this is going to be quite the upgrade. It's going to be a lot of fun. There is a link in the pinned comment below where you can sign up. It's an affiliate link. Rick has been nice enough to kick a little bit back to the show. It doesn't cost you any extra, and I would love to see you there. Okay, super excited, Rick. That was fun. We've got a lot of questions here. Want to tackle them, and starting off with uranium. Jeff wants to know, this is what I like to call a first world problem. He says, Rick, I've had significant growth in some of my uranium investments, some of them with over a 400% increase, and I've only sold about 1/6 of these positions. I'm in two minds about selling more. Is this considered greed?
Well, there's nothing wrong with greed, first of all, if it's intelligent greed, but yes, of course. What you need to do really is decide for yourself, risk versus reward, where the best place to put your money is. If you can afford the speculation, and if you can afford to wait through the next phase of the uranium bull market, then absolutely positively hold them. I believe that the easy money in uranium has been made. When the sector went from unloved to liked to of interest, the easy money was made. To make the easy money, you had to buy it in 2022, when, Steve, you and I talked about it in your show, and people questioned our sanity. I believe, as a consequence of the changing nature of the uranium market, the fact that the selling of the product is going from the spot or overnight market to the term or long-term contract means that the certain money is in front of us. But you'll have to be patient, and you'll have to do the work to make that certain money. I absolutely will make it. I will share my findings from time to time with Steve Barton and his audience. But the truth is, individual asset allocation is an individual decision. There is no one-size-fits-all answer.
I really like your selling past the point of concern, because that takes, I did that with Global Atomic, and I really don't care what happens in the share. It's free.
Right.
Yeah. Okay. Wilson and User wants to know about NexGen. Rick was bullish on NexGen. Is he still bullish on them after the physical uranium purchase and the conditions around cash spending?
I love the deposit. I hate the general and administrative expense. I'm going to listen to their webcast where they attempt to explain away this existing transaction. For those of you who don't know, they sold a convertible security to buy 2.7 million pounds of uranium. Buying 2.7 million pounds of uranium at $25 or $30, like Sprott did, was a very good idea. Whether or not buying that at $100 was a good idea is something that we will need to see over time. If that uranium was purchased so that it could be used to secure a uranium purchase agreement to help monetize their reserves, then it may have been a good idea. But the idea that they pay 9% interest, which is convertible into equity, which is to say they dilute their interest in the best uranium deposit, undeveloped uranium deposit on the planet, that's problematic. The second thing that's problematic is that these guys aren't yet producing companies, and they are spending $30 million a quarter in various places. So I need to visit with the company about where this expense is going. If this $30 million a quarter has to do with de-risking the project, really, if it's advanced engineering, if it's purchasing of long lead time items, if it's sociological support with First Nations, then it becomes more understandable. But the idea that you're spending $120 million a year pre-construction seems excessive to me.
Yeah, 300K a day seems seems a little expensive. I was a little I don't own NexGen anymore, but well, I guess that's not true. I own it through URNM, but anyhow, yeah, 9% interest seems like a lot. Okay, Sam wanted to know about UROY, given the recent Russian import ban. How do you feel about UROY?
What I like about UROY is they've started to deploy the money. Also, their working capital has risen because part of their working capital was physical uranium. So their working capital went up an old-fashioned way. It wasn't looting institutions or widows and orphans with an equity interest. It was, in fact, a revaluation of their inventory. The last time you talked to me about uranium royalty was about a year ago. And I said it seemed to be trading at a premium price, as though they were valuing cash at a premium. But the truth is that the company's beginning to grow into its valuation, which is very attractive.
Okay, what ranking would you give them now?
I have UROY as a 5 right now. I want to see the allocation of the rest of their money. I want to see, I know of 2 opportunities for deployment, which I've shared with the company. I want to see what they do with their remaining cash.
Okay.
Before I upgrade it or downgrade it.
Yeah. Okay, Derek wants to know Uranium Energy Corporation.
I own UEC. I think it has several advantages. Let's talk about the disadvantages yet. Rather than having one big mine, it's a collection of small mines, and I don't like small mines. The fact that there's a hub and spoke, which is to say that you consolidate several small mines in South Texas and several other small mines in Wyoming around a central processing hub, I do like. I like, too, the ability that they have to produce 8 million pounds of uranium a year in the United States. Ex-politics, it wouldn't matter where the uranium is produced, but the world doesn't exist ex-politics anymore. I think that they will be a psychological beneficiary of the ban on Russian imports imposed by the United States. Now, let me be clear, from a real viewpoint, it doesn't matter at all. The uranium that we don't take in the US, the Russians will sell to the Chinese and the Indians. And the uranium that goes to China and India, primarily from Canada and Australia, will come to the United States. It's all political theater. But in the near term, narrative matters to stock prices. And Amir Adnati has spent probably $70 million in financial public relations over the last 20 years, building a 90,000 person constituency in uranium energy. That's 90,000 people who care about every possible piece of good news. So in the near term, the narrative becomes at least as important as the reality. And all of the narrative around uranium energy is great. Traders need to continue to pay attention to uranium energy. Investors need to pay attention too, but with a much longer duration.
I remember about a year and a half ago, or maybe 2 years now, we were talking, it was shortly after the invasion, so about 2 years ago, and you said that you could see a premium being put on American uranium companies, and that's playing out.
Two premiums in effect. One, I think there will be a premium in term contracts where U.S. utilities, Duke Power, Southern Company, people like that, are willing to pay a premium for U.S. uranium. In other words, to absolutely, positively, without a doubt, have access. But the Biden administration, in their wisdom, who 4 years ago hated the uranium business, have decided to subsidize it. So the cost of capital that American producers have, courtesy of the taxpayer, may go to zero or even sub-zero. The idea that you sell your product for a premium and you have a subsidized cost of capital, however unpalatable that might be to libertarians like myself, is attractive to speculators who have learned to attempt to monetize the stupidity of the voters.
Yes, well put. Okay, Denison Mines.
Denison, I am no longer an owner of. If they make their in situ recovery experiment at depth work, this is going to be a long ball home run. What I like about Denison is two high-grade discoveries in the Athabasca Basin and an interest in a permitted mill and tailings facility. They don't have to permit stuff because they're already permitted. The market has taken real note of those attributes, and I was up 400 and something % on my Denison. And I saw a lot of the value in Denison around their attempt to apply in situ recovery technology, but not at surface, at depth. And I'm not sure it's going to work. If it does work, I'm going to look like an absolute moron. There is so much opportunity available for me in the uranium space that I just decided that I would pocket the win I had and not allow myself to worry about the efficacy of that technology.
Okay. All righty, moving on to gold and silver. Thank you for the introduction to Doug Casey, by the way. That was a really fun interview. We went a deep dive into his 9 Ps of resource stock investing, and then he got us in touch with Lobo Tigre. We had him on the show, and he proceeded to share with us his what he called his greatest life's work, the pre-production sweet spot, which he gave to us for free. There's a link in the notes down below if you guys want to check that out. So just to summarize that, you and your team looked it over, and as Lobo said, you could find no flaw. And basically, it is that from when a junior goes into the development stage, they start construction. They're actually building something. They're pouring concrete. They're building. The time frame from that to first pour is about 2 years, and it averages about a double. Is that accurate?
Yeah, and we actually, it sounded too good to be true, too predictable to be true. And we had a couple of interns who back tested it, and they corroborated it exactly. When that didn't work, when that worked, I didn't believe it, and I pulled some data at random. And as I say, I found no flaw. It would appear that the boring period of the Lassonde curve, which is to say the period of obtaining permits, obtaining financing, doing advanced engineering, wears investors out. The beginning of the end of the period where you wear investors out would seem to be for shovel. The permits have been obtained, the financing has been obtained, the lead engineering is done, the long lead time items have been done. That period from, if you will, first dirt, when you break ground, to production. And by the way, I would have suggested the nameplate capacity, which is to say not merely on time, on budget completion, but rather completion where the deposit begins to produce or not at the rate that it was intended to produce. That's the way I would have played it. Turns out statistically, Lobo's right and I'm wrong. What he suggests, which is commencement of construction until technical completion, averages a little more than 2 years, and averages something like 100% rate of return, which is extremely attractive from my point of view. It may be that if his work becomes popular, that the market will arbitrage out the return, but the return exists, at least on paper, back-tested for 20 years today.
Yeah, I remember a similar scenario when I was playing poker semi-professionally, and when computer programs came out, we would talk on the show for over an hour about one hand, and now you can run it through a computer, and it literally gives you the answer of what you should do in a specific hand in a specific scenario. And I kind of feel like Lobo stumbled across something like that today with the pre-production sweet spot.
Well, I don't think he stumbled across it. Lobo's a very hard worker. He came to work for Doug Casey 20, 25 years ago, green as grass. Doug recruited him because he was a very smart guy. He was a passionate anarcho-capitalist, and he was a very, very, very hard worker. I was going to say fast forward, but that's wrong. 25 years ago, slow forward. He has developed into an experienced thinker in natural resource investing. So when we say he stumbled across something, that probably doesn't do justice to his process. Lobo studies, he doesn't stumble.
Okay, good choice of words. All right, with this couldn't help me. I couldn't help but think about G Mining Ventures, and with the pre-production sweet spot, they are coming into production second half of 2024. Is this something that you would be watching with this company?
I mean, in fairness to say, we've already generated 100% return from the production discussion till now. The advantage that you have with G mining is that the next phase, where you go from substantial completion to nameplate capacity, the next risk is a risk that this management team has dealt with 5 or 6 times before, in my experience. They are wonderful, wonderful, wonderful mine builders. The stock is a little soft right now, ironically, because they did the right thing. They are acquiring Reunion Mining, which has a 5 million ounce plus, very rare discovery in Guyana. And the market was concerned around Reunion as to who would build it. Could it be completed on time, on budget? The acquisition of Reunion by G Mining solves 2 problems. When people look at G Mining, they think, how do they grow? What's next? Well, you see what's next, Reunion. When people look at Reunion, they say, how do you finance it? How do you build it? That's been answered. G Mining. So I think this is a wonderful circumstance, particularly a wonderful circumstance if you are a believer in higher gold prices. It's important to note that the Gignac family has the explicit backing of the Lundin family, as a consequence of the Gignacs building Fruta del Norte in Lundin Gold. When I allow myself to fantasize, Steve, there's a deposit to the north of Reunion called G2, which I believe is part of the same mineralized event. Consolidating G2 into Reunion takes what appears to me now to be a 5 million ounce deposit and takes it to being a 7 million ounce deposit, probably on its way to 10. So that amalgamation, which is by no means guaranteed, but is by every sense logical, I think is attractive. And it wouldn't surprise me, given the high regard that the Lundin family has for the Gignacs, for the whole kit and caboodle, which is to say G Mining, Reunion, and G2, to end up as part of Lundin Gold. This amalgamation theme is important, but amalgamation only works when the dominant shareholders know and like each other. In this circumstance, the part of the puzzle which remains difficult would be Reunion and G Mining, where the management teams aren't close. If that were able to occur, my suspicion is that Lundin Mining and that amalgam would fit together hand in glove.
Okay, good. Yeah, I was pretty excited when I saw that they were merging or getting acquired. Okay, Molnar, Doman, and Wilson want to know about, can you ask Rick about the current status of Equinox Gold? Thoughts on the Greenstone purchase? Thank you.
The Greenstone purchase, for those of you who don't know, Equinox has been engaged for 2 years in building a very large mine in northern Canada. By the way, one that I think is generational. The weakness in the Equinox stock over the last 2 years has been a consequence, I think, of the investment community's skepticism about the probability of on time, on budget completion. 40% of that mine build was financed by a mining finance house called Orion. And Orion, now that they have effective completion of the deposit, has elected to sell their 40% interest in the deposit back to Equinox so that Equinox will be 100% owner. Make no mistake, this is a premium priced acquisition. Equinox did not steal the deposit. They paid an absolutely full price. If they obtain nameplate capacity, which is to say, if the deposit produces as forecast by the feasibility study, this will be a very good acquisition. And it will vault Equinox in this one transaction above the 1 million ounce per year threshold, which will make a difference in capital markets. The risk is that they paid a premium price for a deposit which will have teething problems. Remember that Equinox is ultimately controlled by Ross Beatty, who is now the non-executive chairman. I love this. I've done business with Ross since university, which, as you can see by my face, is a very long time. And his teams have a hallmark of frugal financial management and on time, on budget completion. So I'm personally very bullish about the outlook for Equinox. But the risk is, as I say, that they paid a price that turns out to be too much if the deposit doesn't achieve nameplate capacity.
Okay. And what ranking would you give them right now?
I raised them last week to 4. Now, your people need to understand that my rankings are normally extremely empirical. This one partially was the consequence of a long discussion that I had with Ross Beatty about the deposit, about the progress, about the amount of time that he has spent there, and about his personal certainty that they will achieve nameplate capacity. It also has to do with my underlying bullishness about the gold price. I personally am, over the 2 or 3 year term, very, very, very bullish about the gold price. If I'm wrong about the gold price, then my ranking is pure fiction.
Okay. I hope you're right. We're betting on it, literally, as we think so too. Okay, Simon wants to know, can you ask Rick about EMX royalty?
I'm a large shareholder of EMX. I should say I'm a large shareholder of Equinox too. I need to disclose conflicts. EMX Royalty is a company that I helped found many years ago. I recruited the CEO to run it. He's done a truly spectacular job of running it. For those who don't know, the company is a hybrid company. They are a prospect generator, which means that they use their technical acumen and their business competence to generate exploration targets, which they then joint venture with other companies. Rather than taking a carried minority working interest, which is common for prospect generators, as compensation, they take equity, sometimes cash fees, but importantly, a royalty. In addition to generating their own royalties, and by the way, they've generated almost 200 of them over 20 years, they purchase royalties. I would suggest to you that the market capitalization of EMX royalty is explained away in one asset, the Timok royalty in Serbia, currently producing, operated by NexGen Mining, now the largest by market cap gold mining company in the world. But that royalty doesn't account for the deeper part of the Timok porphyry, which will ultimately become a top 10 copper gold producer in its own right. My belief is that the Timok royalty explains away the entire market capitalization of EMX, and you get the whole rest of the company for free. Now, note that playing a game where a royalty realizes its value over 5 years is not suitable for a speculator who has trauma holding stock over a long weekend. The shares of EMX will experience extraordinary volatility, rising and falling 10 or 15% in a week due to circumstances completely unrelated to EMX. As an example, if it's owned in a hedge fund that experiences a redemption and the hedge fund has to sell their shares into a thin market, the stock will fall. By contrast, if the stock comes to the attention of a mutual fund or gets added into an index, the stock can rise 10% for reasons that are absolutely unrelated to the fundamentals around EMX. If you don't have the stomach for the volatility around a stock that can go up 10% or down 10% with the same ease that you inhale or exhale, don't own the stock.
I didn't know you had a hand in helping form that. That's pretty cool.
It was originally called Southern European Exploration, proposed ticker symbol when I was younger, SEX. It was formed around exploring the exploration potential in Serbia. They vended off their Serbian holdings to a company called Reservoir Minerals, which discovered the Timok deposit that we just talked about. It's been a 30-year journey to be an overnight success.
That's awesome. What ranking would you give them right now?
I have EMX as a 4, and I am considering an upgrade to 3 as more information comes out from ZGen Mining about the Timok royalty. There are other royalties, by the way, which sustain things. They have a royalty on Lundin Mining's Caserones copper deposit, which generates a lot of money. They have a royalty on Barrick and Newmont's Leeville project in the Carlin Trend. But the royalty that I'm the most excited about is this Timok royalty, because Timok is a monster. It is a generational mine, or perhaps a multi-generational mine.
Yeah. Okay. How about Jeff wants to know Orogen royalties?
I've been talking about Orogen on your show for what, 2.5 years now?
Yeah.
Another small royalty generator. They are enjoying income now. They aren't just cash flow positive, they're profitable. Based on the Ermitaño royalty operated by First Majestic in Mexico. It's also worthy of note that they generate enough money from prospect generation and management that the company's exploration activities are cash flow positive in their own right, which is truly a spectacular outcome. But the upside in the stock is represented by the Silicon royalty, major discovery by AngloGold, where Orogen has a royalty. We don't know how big this deposit is yet, but it looks as though it's going to be a 10 million ounce deposit in Nevada, discovered by AngloGold. It's difficult to quantify the valuation because we don't have a pre-feasibility study. We don't have numbers. But the upside afforded a fairly small market cap company that's already profitable as a consequence of their silver royalty and generation fees means that time is really truly on your side with this.
Yeah, I'm looking forward to this one. We're up 65% since your boot camp. It just keeps going. What ranking would you give them?
I have Orogen now as a 5. It was a 4. The fact that the share price has done so well has made it on a valuation basis less attractive. Fun to own, less fun to buy.
Yeah. Yes. All righty. Derek wants to know about Gold Royalty Corporation.
Gold Royalty is another one that I thought was very fully valued 1.5 years ago, but they've begun the process of monetizing their royalties. For the people in your audience who don't know the origin of Gold Royalties, it was formed by a wonderful young entrepreneur, Amir Adnani, who began in the process of a related company, Gold Mining Inc., of buying advanced gold deposits during periods of time when the outlook for gold was very poor. Young Amir spent 15 years buying, if my memory serves me correctly, 22 gold deposits that had fortunes spent on them, but weren't economic at current gold prices. Fast forward, the gold price goes up. Companies are able to attract capital fairly cheaply in the royalty business. And so Amir burdens all of his own properties with a royalty, spins them out, went out to raise $20 million, came home with $90 million, and began to use both his currency, which is to say his stock, and his cash to buy other royalty companies, amalgamation in the royalty space. Then he did something brilliant. He hired a guy named David Garofalo, who was a senior executive in the industry, been part of the growth of Hudson Bay, part of the growth of Gold Corp, to come in and be his partner at Gold Royalty, with the job of monetizing, beginning to advance these projects that he'd bought cheaply, doing joint ventures with other companies, whatever it takes. The idea is that you're not a static property owner anymore. You bought the properties at $500 and $600 gold with the view to monetizing them in some fashion, selling them, developing them, doing joint ventures when the price of gold went above 2,200. Amir has done exactly, precisely what he said he was going to do. Importantly, this royalty package has begun to mature. Again, they're cash flow positive. They're not yet profitable because they're spending enough money on general and administrative expense to beneficiate these properties, with a 2 or 3 year duration, that they're not currently profitable, but they are in fact cash flow positive with lots of growth to come. I have Gold Royalty as a 5. Again, not because the company's progress hasn't been astonishing, but rather because the market has rewarded them.
Yeah, Cote is pretty exciting.
Cote is very exciting. This is a project, for those of you who don't know, that was 2.5 years behind schedule and more than double budget. It almost broke IAMGOLD, but it is a generational deposit. It will produce well in excess of 5 million ounces. They do have on time, on budget completion. It will, when it is up and operating, be the 3rd or 4th largest gold mine in Canada, and it'll produce for decades. And of course, Gold Royalty owns an overriding royalty on this deposit, which will start paying in spades within the 12-month time frame.
Yeah, and what I love about these royalty plays is, the over budget, way over time. They just don't get a check as soon, but they don't have to deal with all that, it being the royalty company.
Steve, what you say is so important. 3 attributes. First of all, big deposits like Cote always yield you surprises. And in big deposits, the surprises are always good. That's very useful. It is likely that starting life with a 5 million ounce reserve, after 5 years, they'll still have a 5 million ounce reserve because they'll discover enough gold to replace production. The second thing is that when the operator is passing out bills for the construction expense, the royalty holder doesn't get a bill. And when they're passing out bills for operating expense, the royalty company doesn't get a bill. In this sense, on an operational basis, your gross is your net. Those are very attractive margins.
Yes, very attractive. Okay, Esperan, I thought had a pretty interesting question on dividend plays. He says, Rick's recommendation for long-term investors with the big majors such as Exxon, Chevron, BHP, and Rio Tinto. Are they buy and hold type of investments to pass down to the next generation and simply live off the dividends? Or should we still look for periods to sell enough to cover your cost basis? Also, do you recommend reinvesting your dividend unless you need the liquidity?
There will be periods of time when the oil market or the copper market or the iron market is in such favor that the market capitalization of these big companies will exceed the net present value of their assets. And then they must be sold. Right now, they're out of favor. It's important, if you buy these stocks for income, that you examine the interplay in the company between the balance sheet and the income statement. Specifically, a company that's dividending out all of its cash isn't reinvesting enough money in its assets to make that dividend sustainable. A company like Exxon that's generating a boatload of cash and simultaneously making sustaining capital investments, new project investments, and by the way, buying Pioneer for $60 billion, means that they are increasing their dividend capacity at the same time that they're increasing their dividend. It's really important that you don't buy these stocks based solely on yield, but rather on their ability to continue and even grow their yield over time. All of that said, This is a very cyclical business. When the business comes back into favor, and it will, I can't tell you when, you need to consider the capital that you have tied up in that business relative to what the business is worth and relative to what opportunities you have in other businesses that are out of favor with the market and hence cheap at that time. Remember, please, resource-based businesses are capital intensive and cyclical. In that circumstance, you are either a contrarian or I guarantee that you will become a victim.
Okay. All right. When it becomes, when the market cap exceeds the net asset value, when it becomes expensive, trim your position.
Yep.
Okay. And let's see, nickel, copper, iron ore, Centaurus Metals, Lost Cause, and Petrov wants to know, feasibility study coming. Interested to hear about Rick's thoughts on their new concentrate-only approach.
I think that the concentrate-only approach, which is to say the capital light approach, is interesting. I think they need to spend 6 months, 8 months studying it. Lost cause, not at all. The stock got cut in half because the nickel price fell. I think that the nickel market and this stock will continue to be hated, and I will continue to buy it the same way I bought uranium stocks in 2022. Make no mistake, Centaurus has some spectacular advantages. It is maybe the biggest undeveloped sulfide nickel deposit on the planet. It is a true tier 1 deposit, which is to say in situ value of reserves and resources exceeding $10 billion. It will be easily in the lowest cost quartile for sulfide nickel deposits worldwide. It should generate a return on capital employed even at today's nickel prices in excess of 25%, which puts it easily in the best decile of sulfide nickel deposits in the world. And people hate nickel. We actually, I think, are going to do a boot camp, not the next one, but two boot camps out around tier 1 deposits, where we do a boot camp that features 4 deposits, each of which are tier 1, and each of which are hated by the market. When I look back at my career, Steve, I made reasonable amounts of money trading stocks. I made good money building businesses, but I made most of my money on 10 baggers. I made most of my money buying companies that were misunderstood and commodities that were out of favor, where I believed that they were selling at a 50% discount to their current net present value, and where I could see a path to a 10-bagger in 4 years. That happens best in world-class deposits. It happens best in $10 billion plus in situ reserve and resources companies, particularly when the commodity that they're invested in is out of favor and has to go up in price. I'm tempted to call this upcoming boot camp the 10-bagger boot camp as opposed to the tier 1 boot camp. There's certainly no guarantee that any of these stocks will go 10 for 1, but they all exhibit the characteristics that generated for me the 10 baggers, 15 baggers, and 20 baggers in my past. And Centaurus, should they agree to, will definitely be included in this boot camp.
For marketing purposes, I think you should call it the 10-bagger boot camp.
You know, marketing sadly is not my long suit. So.
I'll fill in the gaps where I can. What ranking would you give Centaurus right now?
I have Centaurus as a 4. On a valuation basis, I would absolutely upgrade it to a 3. But I think that nickel will be out of favor for at least 2 years. I also think that there is a chance that Rio might swoop in and grab the whole company. That would occur at a premium, a nice premium to today's price, but it would foreclose or preclude my ability to enjoy a 10-bagger.
Yeah, they'll buy it for 20%.
Ironically, this is something where I don't want to see a 50% markup. I want to see a 5-year 1,000% markup.
Yeah.
This deposit will get bigger, and the grade of the deposit will grow as they do more infill drilling. The nature of these deposits is that the more you know about them, the better they get. A lot of the mineralization will be controlled in fairly discrete feeder zones or in high-angled faults. And you don't find that grade on 100-meter centers. You find that grade on 25-meter centers. So the deposit will both grow and get richer at the same time that the process technology questions answer themselves with work.
Okay. TB wants to know, what does Rick think of Vale at its current value?
I am not an owner of Vale at its current value. I'm very attracted to its iron assets, but the outcome of the tailings dam fail in Brazil is very much a work in progress. Whether their ultimate liability is half of $18 billion or half of $30 billion is another circumstance. Make no mistake, it's a liability. That tailings dam failure was not the fault of the weather and not the fault of Brazil. It was the fault of the operator, Vale. So until I see the resolution, the political resolution of that liability, I can't own the company, despite the fact that it is stupid cheap.
Okay. All right. Antonio wants to know, can you ask Rick on the best books to read for oil and natural gas?
There aren't any that I'm aware of that are one size fits all. There's a name, if you remind me via email, that I will share with you that has to do with investment decision analysis around natural resources. I don't have the book in front of me. And I caution you, if you aren't prepared to do a really deep dive, this book is primarily a cure for insomnia. It's a very, very, very hard book around how you make investment decisions on a risk-adjusted net present value basis. In terms of easy-to-read primers, I don't know one. I would encourage anybody with an oil and gas portfolio that exceeds $250,000 to become an online subscriber to the Oil and Gas Investor, which is a monthly publication done by Hart Publications. I've been a contributor on and off to the Oil and Gas Investor for 35 years, so for a very, very, very long time. My memory is that a subscription is something like $400 and is insanely cheap if you want to know that much about your portfolio and want to work that hard.
Okay. All righty. The Oil and Gas Investor. All right. And we have a question from NHL Pro. Hi, Steve. Can you ask Rick's opinion on natural gas producers? With natural gas being this cheap, are the companies still profitable? I've got a chart here of natural gas, and as a trader, I can't help but notice whenever it touches this white line around $1.50, we seem to have a pretty good time afterwards. You know, the last time was 2020 and then 2016, 2012. What are you seeing in natural gas, Rick?
Well, understand too that that line isn't inflation adjusted.
True.
It's important to note that natural gas is too cheap, and I think it's going to stay too cheap for a while. In the United States, the natural gas market is burdened by the fact that natural gas is produced as a byproduct of oil production. And in particular, the West Texas producers, the Permian producers, don't care about the gas price. They're making so much money in the oil business. What that means, however, is that demand for natural gas is literally exploding. I said on your show before, Steve, that the cure for low prices is low prices. And the low price for natural gas is encouraging consumption and encouraging investments in things like infrastructure, in fertilizer plants, in petrochemical plants, in natural gas export liquefaction plants. This is the perfect setup for when the development expenditures for oil and gas in the Permian Basin begin to decline, which I think happens in 2025. At the same time, the Canadian natural gas market is constrained by the same reason, and further constrained because the guy who runs the country, Mr. Trudeau, doesn't seem to see the business case for the export of Canadian natural gas, although all of his major trading partners do. The only one in the world who seemingly doesn't see a business case for Canadian natural gas is the Prime Minister of Canada. I guess he can't see the business case because he won't allow it. Despite this insane setup, gas producers like Devon in the mid-continent in the United States, Equitable in the Marcellus in the U.S. Northeast, Peyto, Birchcliff, Tourmaline in Canada, are not only profitable, but are generating really, truly spectacular dividend income with enough reinvestment to sustain the production. This is an odd paradox where you don't have to worry too much about being too early because the dividend shelters you from the time value of money problem. Note to listeners, I'm way long the gas stocks, but I'm also extraordinarily patient.
Okay, I'm going to share my screen here. There's two that you turned us on to, and one of them, well, you've mentioned both of them, Devon here and Equitable, and they arrows are our entry points, buying, doubling our share count as it went down. So we got way in the black really quick. They're actually turning a profit here, right? I mean, selling, pulling this stuff out of the ground for $2 or $2.50, and then selling it to Asia for like 8 or 9. Is that accurate?
Well, that's a sort of a gross number. In terms of Devon, their cost to produce natural gas, if you factor in their oil production, is probably damn near negative. What's important, and the differential that you talk about is producing U.S. natural gas at $1.50 or $2 or something like that, delivering it for 50 cents to the U.S., to the Texas Gulf Coast, and then selling those cargoes in Shanghai or in Tokyo or in Rotterdam for $7.50 or $8. There's an insane differential between liquefied natural gas FOB Texas and then the price that you sell the cargoes for in any of Tokyo, Seoul, Shanghai, or Rotterdam.
Okay.
What's important to note is when you pick natural gas stocks, don't buy them just for the gross yield. Buy them for the sustainability of the yield. It's important that their recycle, their reinvestment ratio is sufficient enough that they'll be able to maintain production, maintain cash flow generation, maintain the dividends 2 years from now, 3 years from now, and 5 years from now.
Okay. Make sure the rent is going to keep up.
Yep.
Is there a fund where, going back to the natural gas one, we're just at a real interesting inflection point here. I've been looking for some kind of fund. The futures market already got it figured out, so I missed that boat. But like FCG or UNG, like none of them really seem to correlate with the natural gas futures prices where you can play this in any real sense. Do you know of one that would, like maybe a small company or something that might be really tied to this futures price?
I don't.
Okay.
As I understand the futures fund, what they do is they continue to roll off near-term futures, which means they have transaction costs, which are probably prohibitive relative to other types of ETFs.
Yeah. And there's okay. Everyone's saying the same thing. We can all see the chart. There's just not a great way to bet on it. Okay, real quick, tin. Adam wants to know, what's Rick's outlook for tin price and equities over the next 5 to 10 years?
Tin is the forgotten energy transition material. I mean, the tin price has done well in the last 2 years. I think tin continues to do well, to the extent that there's ever any need to solder anything for electricity. Tin will do well. It's the best substance in the world. Tin production is fairly constrained too. The best tin stock that I know of, if you have a tolerance for real political risk, is Alphamin. I'm a very large shareholder. I have been for a very long time. It has the highest grade and longest duration tin asset on the planet. Its concession, I think, has been about 15% explored. I've been there. But when I say there, I'm talking about northeastern Congo. So you need to take into account the most dysfunctional place in a totally dysfunctional country. Risks include AIDS, Ebola, warlords, and you have to truck the material from where it is to where you can sell it, which is Rwanda and Uganda, in a war zone. Despite that, the company is minting cash and is generous enough that it is distributing a fair bit of cash to longtime shareholders like myself. So if you want a really, really, really attractive tin play, and you can suffer insane political and social risk, as I say, it's by a factor of 2, the highest grade tin mine in the world. Production will double over 2 years. But every time you look at the nightly news, you'll be scared to death about your investment.
Okay. What about Metals X? Do you follow them?
Yeah, I like big deposits. I like low-grade deposits. Metal X is all about optionality in tin. And I have learned that optionality equates to marginality, which is to say it's wonderful when it works for you, but you're taking too much risk.
Okay. Awesome. Well, thank you very much, Rick. This was a lot of fun. I want to say that we have your Rule Classroom. There's a link down in the show notes to your Rule Classroom. You do a live Q&A, and I will be there co-hosting with Albert on Thursday for the live Q&A. I'm looking forward to that. If your question didn't get asked, ask Rick yourself. Put it in the chat there, and we'll ask him on the air live and get his answer.
Steve, I need to say that all of this, the Rule Classroom, the boot camps, the symposium, they're meant to be consumed in the context of the Rule Classroom. The Rule Classroom has almost 200 hours of instructive material there, including 11 specific hours around various aspects of securities analysis in natural resources. You can start the conversation easily. Go to ruleinvestmentmedia.com, list your natural resource stocks. I personally will rank them 1 to 10, but that's just the beginning of the conversation. If you want to learn how I develop my rankings, go to the Rule Classroom. If you want the ability to employ the knowledge, go to the question and answer sessions on Thursday. If you want the ability to make money on them, then by all means, attend the boot camps and attend the Rural Natural Resources Investment Symposium, particularly because it's riskless to you. If you don't feel for any reason that we didn't deliver you value, email us. We'll give you your money back. This is a no-brainer.
Yes, I am really looking forward to it. We hope to see you out in Boca Raton at the symposium. Come by the booth and say hi. I would love to meet you in person, share a drink on the boat cruise. If you can't make the symposium in person, then check out the live stream and watch it as many times as you want. There's a link in the pinned comment below. We will see you there. Prices go up May 15th at midnight, so sign up today. It's July 7th through 11th. Rick, thank you again. Real pleasure.
Always a pleasure. I look forward to visiting with you on Thursday.
We'll see you there. And thank you for tuning in. Hit the like and subscribe and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.